Welcome to CallWiz, where we break down earnings calls. Today we are on SpaceX, ticker SPCX, and their second quarter of fiscal 2026. The first full quarter they have reported as a public company, coming out of Bastrop, Texas.
And it was not a quiet debut.
Not even close. Milestone language from the jump. Revenue nearly doubled. Starship version 3 flew twice, and they rebuilt the balance sheet. Cash ended at $100 billion after the IPO and the bond deal. That is the frame.
Okay, hit me with the four numbers that actually matter.
Revenue printed 7.8 billion. Street was looking for about 6.9, so a clean beat, and that is up 92% from 4.1 billion a year ago. Growth accelerated across every segment.
That is not a gentle ramp.
Adjusted EBITDA came in at 3.5 billion, up 191% from 1.2 billion, grew roughly twice as fast as revenue. Net loss was 541 million, a 467 million improvement year over year. So losses nearly halved even while they pour money into Starship and AI. And cash finished at 100 billion.
Scoreboard says the flywheel is spinning faster than the capital going in. That is the takeaway they want you to leave with.
Exactly. Capital expenditures hit about 18.4 billion in the quarter, 15.8 of that into AI compute alone. Backlog sits at 47.5 billion. They raised 85.7 billion net from the IPO and layered on a 25 billion investment grade bond deal at a weighted average 5.855%. Brett Johnson basically said the new AI deployments are paying back in under a year. Capital almost behaving like cost of goods.
Under a year payback on compute while you are still losing money at the bottom line is a weird, powerful mix. The filings back the trajectory too. Revenue went from 4.7 billion in first quarter to 7.8 here, and the operating loss collapsed from nearly 2 billion to 143 million.
Three segments, one system. Space is the launch engine. Connectivity monetizes the constellation. AI turns the hardware edge into a third revenue stream. Second quarter is the first quarter you can see all three firing together.
Walk the engines.
Space did 962 million, up 29% year over year and 55% quarter over quarter on larger customer missions and a richer mix. First half, they put 1,041 tons to orbit. Elon says Falcon is still 80 to 90% of everything Earth sends up. Segment adjusted EBITDA was a 205 million loss because they are flooring it on Starship research and development.
And the Starship story on the call was almost casual about solving the hard problem.
Flight 13 went incredibly well. Heat shield looks robust, the ship is still floating, and they plan to recover it. Elon said he would consider the heat shield problem solved at this point. They want to attempt a tower catch of the ship on the next flight, tentatively end of August, and Flight 14 should deploy the first operational version 3 Starlink satellites. Cadence target a year from now is at least one flight a day.
If the heat shield really is done, the whole reusability timeline compresses. That is the single biggest technical risk they have been carrying for years.
Connectivity is the cash engine right now. 4.3 billion in revenue, up 66% year over year and 32% sequentially. Record 1.7 million net new consumer subscribers, best quarter ever, while average revenue per user held flat at $66. Enterprise and government revenue jumped 108% year over year. They signed American Airlines plus Southwest, Virgin Atlantic, Iberia, Aer Lingus. Gwynn said they have never lost an enterprise customer and aviation is still under 10% penetrated.
Customers flying shorter hops just to stay on a Starlink plane is an absurd proof point, and more than 6 billion in US government contracts in a single quarter is not a pilot program.
Segment adjusted EBIT 2.6 billion, up 64%, with nearly 3 points of operating margin expansion. Constellation sits around 10,200 satellites, 9,600 broadband delivering roughly 800 terabits per second downlink across 167 markets.
Then they drop the version 3 math, which is where Elon says people are really underestimating Starlink.
Version 3 is an order of magnitude more capable than version 2, and they plan to launch an order of magnitude more of them. That is roughly 100 times the delivered bandwidth. Even if monetization per bit drops by 10, you still get a 10x revenue step. Critical mass of about 1,000 V3 birds around second quarter next year is when service quality jumps hard. On mobile, next-gen satellites start flying next year. EchoStar's 65 megahertz integrates later next year, and Gwyn framed it as roughly 100x better than today's 5 megahertz partner setup. She pointed at the big 3 US carriers doing about 600 billion a year combined and said their service will be better and eliminate dead zones.
That is a real shot at becoming a fourth carrier without the classic $100 billion terrestrial capital bill. Femtocells on Starlink dishes is the efficiency claim they keep coming back to.
AI is the inflection story. Segment revenue 2.6 billion, up 247% year over year and 213% quarter over quarter. New cloud deals at Colossus and Colossus 2 alone added 1.6 billion incremental. Adjusted EBITDA flipped positive at 1.1 billion, first time. Nameplate compute 1.4 gigawatts, up from 1 gigawatt in first quarter and 400 megabits per second a year ago. Exit this year over 2 gigawatts.
And the 2027 power talk got aggressive fast.
Elon is targeting 20 gigawatts of power and cooling projects online by end of next year, expecting something closer to 15 to land. Exclusive on NVIDIA Vera Rubin. Starmind, basically an optimized NVL-72 in orbit, starts launching next year, and they like the design enough to put it on the ground too. His monetization guess, $30 to $50 per watt. Already contracted another 6.7 billion of cloud revenue over 6 months starting in October. Brett says that trajectory plus Cursor puts them on path to 100 billion of annualized revenue run rate by December, based on the December month.
Sub 1 year payback while Grok token consumption tripled after 4.5. They are keeping maybe 10% of compute for internal Grok training and renting the rest. That mix matters.
Capital structure is now a fortress on purpose. 100 billion cash, 47.5 billion backlog, investment grade balance sheet. Priorities stay the same, 3 bets: Starship scale, next gen Starlink broadband and mobile, AI compute, and preserve the rating. Next 2 quarters of capital spending should look a lot like this 18.4 billion quarter.
Filings show free cash flow still deeply negative, about 16 billion out in the quarter. So the IPO cash is the bridge. They are not pretending otherwise.
Q&A is where the second order stuff landed. Goldman asked about enterprise and government backlog conversion. Gwyn, more than 6 billion in second quarter government contracts alone. Sticky enterprise, never lost a customer, aviation still wide open, and Elon expects enterprise to substantially exceed consumer once the sales team finishes re-educating people that uptime is now primary grade, not backup grade.
Morgan Stanley pressed on the 15 to 20 gigawatt line of sight. Permitting, chips, turbines. Elon basically said hardware is their sport. They will overbuild power and cooling relative to GPUs, and NVIDIA is giving them a very significant percent of next year's supply.
City hit capital discipline and buy versus build. Brett, AI capital spending is almost cost of goods like now. Long cycle launch pads are multi-decade return assets. They pulled the internal 1 trillion revenue year from 2031 to 2030, with a non-zero shot at 2029.
Bank of America got the Flight 13 debrief we already covered. Heat shield solved language. Catch attempt next. Deutsche Bank wanted the 100 billion run rate unpacked. Answer: all 3 segments. AI cloud the biggest near-term chunk, plus the V3 step change the street is still modeling off V2 history.
UBS went after Starlink mobile size versus broadband and how much compute stays captive. Gwyn gave the 100 times framing and end of next year service start. Elon, roughly 10% reserved for Grok training long term.
Retail questions got human landing system. Reliable enough for people probably end of next year. Artemis 3 dock next year. Boots on the moon targeted 2028. And confirmation that heat shield is no longer the blocker for full rapid reuse.
So, where does this go from here? Second half is about proving the 100 billion annualized run rate exit, catching ships, and getting V3 birds into operational use. 2027 is the year mobile satellites fly. EchoStar spectrum comes online, Starmind starts launching, and daily Starship cadence becomes the expectation. Human landing milestones stack behind reliability. The 1 trillion revenue pull forward only works if Starlink V3 monetizes anything like the bandwidth math, and if AI hosting keeps clearing sub 1 year paybacks while Grok and Cursor compound.
What I am watching next quarter is simple. Do they actually catch a ship? How fast do the new cloud contracts ramp in October? Does subscriber growth stay this hot once they lean harder into lower ARPU markets? And whether enterprise really starts to outrun consumer the way Elon claims once the sales machine is fully built.
Open risks are still real. Capital spending stays brutal. Free cash flow is deeply red, regulatory timing on catches and spectrum, and execution on 15 plus gigawatts of power is a physics and permitting problem even for them. Competition is invited to copy, but Elon is betting the copy gap stays wide.
Bull case is the flywheel is already visible in the numbers. Revenue up 92, EBITDA up 191, losses halved, fortress cash, and a credible path to that December run rate. Bear case is they are still a heavy investment story that needs every one of those technical milestones to land on time, or the trillion timeline slips back.
Either way, second quarter was the first time outside investors could see launch, connectivity, and compute compounding in the same quarter instead of as three separate science projects.
This is discussion and analysis for entertainment and education, not financial advice. Do your own work.
Thanks for listening and watching. We will see you in the next video.